Good morning and welcome to this Tuesday, September 26th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we try to figure out what's going on in pre-market and where the market could be headed. Today's a big day, by the way, for those stock market historians. July 17th to September 26th is the worst period of the calendar year. And today is September 26th, and we know what we've had since July 17th. It hasn't been pretty. Been in the midst of at least an ABC correction. Some think it's more. I'm not in that camp, but we'll talk a little bit about that during the show today. Got earnings season coming up now in about 3 or 4 weeks. I guess probably about 3 weeks. Some of the big banks will begin reporting. And that is typically a time when the market focuses on earnings and tends to, I guess, worry less about the Fed, the CPI, PPI reports, and so forth, as we got a lot of that in our rearview mirror at this point. The 10-year Treasury yield, though, did break out above 4.35%, closed yesterday at 4.54%, I believe. So a clear breakout. And talked about this is that, possibility of the 10-year Treasury yield being the catalyst for a move lower in that final week of the bearish seasonality period. So we got, a lot of things going on here. I'm going to talk about, both the bullish and bearish state of the market. I'm going to kind of give you some of my key arguments if I wanted to argue bullish thoughts and a bullish market ahead. And also flip, and I'll give you some of the catalysts that could lead the market to lower prices if you so choose to take that path. I can tell you I remain bullish, but I don't remain foolish, and there is a difference. And I'll talk about that a little bit later in the show, but let's go ahead and get this thing going. So bear with me one sec here. All right, this morning, first off, futures. We've got the Dow Jones Industrial Average with about 30 minutes to go. The DIA is down about 0.5%. The S&P 500 or the SPY down about 3/5 or 0.6%. The QQQ down also about 0.6%. And the IWM, which tracks small cap, Russell 2000, down almost a full percentage point in pre-market action. And that takes it down to about 175.75, which was pretty close to where we were yesterday, also close to a key gap support from back all the way at the end of May, early June. I think it was early June. Anyhow, that's what we've got this morning as the market gets ready to open up. The put call ratio has been on the move to the upside. We'll talk about that in a little bit as well. But let's go ahead now. Actually, let me give you oil prices and where we're seeing the 10-year Treasury yield this morning. Currently, oil prices down 36 cents, 89.32 a barrel, and the U.S. 10-year Treasury yield down about 4 basis points, 4.5%. And so not looking great in terms of our futures, not looking great in terms of that 10-year Treasury yield breaking out. Oil prices going up. I sent out a piece to our members yesterday, our weekly market report, and this is designed to focus more on the long-term picture, really kind of steps back and away from what's going on every day, every hour, whatever, in the short term, and focuses more about teaching what to look for from a long-term perspective. And one of the things I pointed out in this past week's weekly market report was that the direction of crude oil prices normally is positively correlated with the S&P 500, meaning, I know a lot of folks are talking about, well, oil prices are on the rise. It's bad, higher inflation. Keep in mind that the Fed does exclude food and energy when they do their core CPI and core PPI. There's a reason for that. These, food and energy tend to be highly volatile. You could literally go from inflation Armageddon one month to everything's back to normal the next. And so they try to strip that out, or they do strip that out because of that volatile nature. Anyhow, the long-term track record, when you see crude oil prices make a big move to the upside, it almost always coincides with a big move up in the S&P 500 as well. Because crude oil, you think of it as, a discretionary spend item, which it is. I mean, when crude oil prices go up, we all have to pay more at the pump, generally speaking. But it's also an indication of global demand. And so it can indicate that global economies are improving. Now, not always, because, crude oil prices can go up because of supply issues. Doesn't always have to be demand driven. There could be geopolitical concerns. There could be a lot of things that aren't necessarily tied to the demand and economic strength globally. But generally speaking, it's a supply and demand commodity. When you have more demand than supply, prices go up. And that, when you have more demand than supply and that demand is increasing, that's generally a signal that global economies are improving. Well, if global economies are improving, then companies that do business around the globe tend to benefit. Their profits rise. And if their profits rise, generally PE ratios will rise. Growth expectations will rise. And so that's where you get that positive correlation. Anyhow, just wanted to point that out. But this morning, crude oil is down about 0.4% to 89.33 a barrel. All right, let's talk about what happened yesterday before we talk about, where we stand in this bull versus bear market argument. Yesterday, the Dow Jones Industrial Average finished up 43. S&P 500 finished up 17. Nasdaq finished up about 68. Mid caps up 14, and small caps up a little less than 1 point. But remember, that's only $177 index or ETF, the IWM. On a relative basis, well, there's a little bit of lagging maybe on the Dow, but overall the others were kind of between 0.4% and 0.6%. So not a whole lot of difference there in the other industry groups. Transports did rise about 0.75%. So we saw a little bit of outperformance in the transports, but you can see that down move remains definitely intact at this point. I'm not seeing any kind of positive divergence. It's hard to sugarcoat. As good as transports looked probably a month and a half ago, maybe 7 weeks ago, they look about that bad now. Straight up back then, straight down right now. Seems to be on the verge of trying to give back a lot of those gains. We'll see whether or not we can hold the current level. From a Fibonacci standpoint, it looks to me, and I didn't do this on Fibonacci, but we went up about 3,000 points, and we've come back down roughly about 1,500. So it looks like we're somewhere around the 50% Fibonacci retracement for those of you who like to follow Fibonacci. So maybe transports are at or getting close to a point where they'll turn. I'd like to see some other corroborating indications, like maybe a positive divergence. Like I said, don't think we're there just yet. From a sector perspective, we saw energy going up 1.25% yesterday. Crude oil prices have been on the move, like we've talked about. So energy's been benefiting there. Materials up about 0.8% or 0.8%. Discretionary up about 0.6% yesterday. And I threw staples in here as well. They were the worst performing group, down about about 1/3 of 1%. So when I look at this, I don't see, on a fairly flat day, maybe a slightly higher day, we're not seeing rotation. Discretionary, continues to outperform staples. We have seen a little bit of a pullback recently, but overall, I mean, you can look at these two charts. I don't even have to pull up XLY, XLP. Look at where we are relative to the low that we saw back in August. We're right about on it. Look at where staples are. Staples continue to fall. Look at where we are relative to the high that we saw back in July. Same with staples. Staples are much further off on a, when you just look, you can see staples breaking down to a 6-month low. Discretionary still trying to hold on to the low we saw just 1 month ago. So on a relative basis, again, a lot of folks talking about, the downside in the market. I just don't see a lot of the big Wall Street firms repositioning out of key aggressive areas and into more defensive areas. That was about as clear as you could possibly see in December 2021, before we hit the cyclical bear market that ended up lasting a little over 9 months. Money rotated heavily in the final push to the upside toward the defensive groups and away from the aggressive groups. And then that only accelerated when the market started turning down in 2022. Not really seeing that here. Maybe this will be a different downturn, but that is normally not the way you see the market when it's about to really move down, not only for, certain percentage, but also over a lengthy period, because time makes it easier for the big firms to get in and out of big positions. If it's just going to be a quick drop, you normally don't see a lot of rotation out of the aggressive groups. And that's, with a couple of exceptions, a couple of groups that had really just gone too far. And I'm talking about semiconductors, software, internet, some of those groups that had just taken off and had gone up so much. We're seeing a little bit of more downside action in those areas. And that's certainly impacting the S&P 500. How far down it goes is probably going to determine how far down those aggressive groups go, probably going to determine what's going to happen to the benchmark. Anyway, let's keep moving here. So steel had a good day yesterday, rising 1 2/3%. Truckers up 1.55%. Coal was actually the best performing industry group, up about 4% yesterday. I don't really talk about coal. Coal is so volatile. It could be our best performing industry group or our worst performing industry group on about half of the trading days. I mean, it seems like it's either always taking a really big move to the upside or a really big move to the downside. So I tend to just ignore that, look at some of the other areas that are a little bit more diversified and a little bit more, give us a little bit more of a signal. So anyway, steel and the truckers, the two best performing industry groups yesterday, support that at least slight rise in the market. But now today we've got markets down again. Futures are down. One thing that we looked at back last year in calling the bottom is we saw a lot of gap downs followed by buying intraday. Yesterday, we saw the market move a little bit lower at the open earlier in the day, and then we came roaring back later in the day. So that is something that we need to continue to monitor as well. All right, 10-year Treasury yield. So today, let me see if I can find. So today we have the Case-Shiller Home Price Index, which was out at 9 a.m. So I can tell you what happened there. It rose 0.6%. So this is the July Case-Shiller Home Price Index. So here we are almost into October. It's a little bit of a lagging indicator, but it rose 0.6%. Market was expecting a rise of 0.7%. Later today, we've got the consumer confidence coming out at 10 a.m. along with new home sales. So I suspect new home sales. Let's see what the consensus estimate is there. So this is for the month of August. The estimate is just under 700,000. It's 699,000 units. Prior month was 714,000. So I wouldn't be surprised to see new home sales going down just because of interest rates. I mean, that just kind of makes sense. The economy would have to really be strong to see new home sales continuing just to go up with rates rising as much as they have been this year. Anyway, I think that is it for economic reports today. Tomorrow we get durable goods orders, which can be somewhat volatile. You really want to look at those over maybe a 3-4 month period at least. But then Thursday, the final GDP for Q2 will be out at 8:30 on Thursday. Jobless claims coming out Thursday morning as well. Of course, that's the normal. Pending home sales, 10 a.m. on Thursday. Got a lot of Fed folks speaking. Jerome Powell speaks at 4 o'clock on Thursday. That's exciting. Little sarcasm there. Friday, we got personal income and personal spending. That'll be out. Also, Chicago PMI and consumer sentiment later that morning. Anyway, that's what we have to look forward to the balance of the week. Earnings still pretty slow. We'll have some reports out later this week, but for the most part, pretty slow. We got a big report coming out from Costco, and I'm not sure which day it is. So let's see when. Might be today. Yeah, it reports today after the market closes. So later today, and this is actually a pretty nice looking chart. I see a bullish inverse head and shoulders where we have the uptrend, left shoulder, neckline, lower low puts in the head, back to the neckline, coming back down, right shoulder. I mean, this one, if we were in the midst of an uptrend in the market, I would be looking for a big gap up, possibly a good report and possibly a good gap up to break out. In this market, where no one seems to want anything right now, makes it a little bit muddier to try to make that call. But I will say Costco has held up better than almost anything in the market, one of the better looking relative charts that I've seen, and they will be reporting earnings after the bell today. All right, S&P 500. So a lot of folks looking at this side right here at about 43.30 and then looking at 43.50 and connecting these lows for a head and shoulder neckline. And if you do connect those, you will see that we have fallen beneath that. I've said before, I'll continue to say it, I'm not a big fan of head and shoulder tops with rising necklines, especially given some of the other things that we need to consider. The one bearish thing that I would say here, though, is that since the Fed announced on Wednesday, we have not had very good action. We've got futures red again this morning. When you look back at August the 25th of 2022, that was the Jackson Hole speech. Remember, we had a beautiful uptrend going. Oops, wrong uptrend. Anyway, big uptrend coming off of that June, July low. Then right here, August 25th happened. That's when Fed Chief Powell said more pain ahead. And you can see we went down, had a little bit of a rally. You can see actually had a little bit of a false rally, went back down, got a double bottom, and then had a rally. And then another leg of selling commenced. Here, we're going down, got a little bit of a reversal there. I don't know if it plays out similar. Maybe we go back down here, double bottom, maybe even a little lower. That's what this did back in early September last year. And then we had a rally. I wouldn't be surprised to see a rally, even if the market does eventually go lower, just because we're getting to the point where we're pretty oversold. And the equity only put call ratio, the 5-day and 10-day moving averages, both suggest that the market is long overdue for a big rally, or at least a short-term rally. So anyway, right now, S&P 500, though, if you do follow this neckline break, it is still below that neckline. So I would say we're probably not out of the woods from a technical standpoint from this pattern, unless we can go back up and negotiate that 20-day moving average. And right now that is at 44.24, which is about 90 points higher on the S&P 500, or a little bit more than 2%. If we can get through that, then I think maybe we'll be dealing with a different market, one that might be in an uptrend heading into Q3 earnings season. But to the downside, I think the big level is going to be 4,300, and that was the high over here, 43.05 to be exact. That was the high back on August 16th. That was also the high. If we look at the weekly chart, the reason that this is significant is on the weekly chart from the top at the end of 2021, early 2022. This was the first move lower. There's two, there's 1, 2, which is the lower high, 3, lower low, 4, lower high, 5, lower low. And so at this point, this was the big resistance. This was the big support. And we traded sideways for the next several months. And it wasn't until June we finally made this breakout over 4,300, 43.05. We have not gone back and tested it until yesterday. Look at the low yesterday, 43.03, 2 points below the 43.05 level, but we held it and tried to rally back. Now, so the question is, do we hold it? because I've said all along, even from the top, when I started talking about the market having some issues, probably going to struggle, seasonality played a role. I said July 17th to September 26th, the worst period of the year. Forget about go away in May. Look what happened to the people that went away in May. They missed pretty big rally. If you went away in mid-July, you saved yourself quite a bit of money. The big difference, this one happened to, pan out almost perfectly. They don't all work like this, that's for sure. But mid-July to September 26th, that's the period when the market tends to struggle. It's the most. Today is September 26th. So today's close marks the end of this bearish historical period. Doesn't mean we just take off. Don't misunderstand. But it's just one more signal to be aware of. Fourth quarter is easily the stock market's best quarter since 1950. And the fourth quarter begins at the close this Friday. That's the September 29th. So when we wake up, come in on Monday morning, we will be in the fourth quarter. Anyhow, so that's the S&P 500. Nasdaq, pretty much the same, except we haven't really seen the breakdown yet on the Nasdaq. Think about that for a second. Wouldn't you think the Nasdaq would be selling off harder than the S&P 500? It's more growth oriented. We're talking about higher interest rates and a recession. Growth stocks should be first stocks being sold, and they're not. Actually holding up pretty well here. Triple bottom though, down around the 14,550 area. Let me give you the exact number here on the NDX. So the close there, well, let's just go with intraday lows. Intraday low was 14,687. This low, 14,557. And yesterday's low, 14,615. So the lowest is 14,557. If we get a big drop and we break below and the volume picks up, to me, this would be a more significant break of a head and shoulder top. First of all, because number one, we got a down sloping neckline, which is to me more notable, because when you break a down sloping neckline, it tells you you're losing support. I mean, if you're down below the down sloping neckline, you're beneath all the key supports, at least over the last few months. With the other, I mean, we're still on the S&P, still trading above 43.05. We finished, I think, yesterday 43.37, which held on to the 43.35 low. It's a little cloudier, that's all. I'm not saying you can't look at it, if you believe in that was the head and shoulder breakdown and you're short, that's fine. Just make sure you keep stops in play in the event we turn back to the upside. I would say that 20-day moving average on the S&P is one I would watch pretty closely. Anyhow, that's the NDX. IWM continues to be the weakest. Some are saying, well, this head and shoulder break is the clearest, because you can see the left shoulder move down, the head, the right shoulder. It is an upsloping neckline, but we broke. Volume was a little bit higher. I don't argue with that, except think about what a head and shoulder top does. What does it do? It supposedly, when you break down, it ends an uptrend. This head and shoulder pattern is the uptrend. There was no trend. The left shoulder started the uptrend. So this would probably be the shortest, quickest head and shoulder pattern to form in the history of head and shoulder patterns. This isn't a head and shoulder pattern. Head and shoulder pattern tops at the end of an extended uptrend and reverses the prior trend before the head and shoulder forms. There was no trend. If anything, it was a downtrend. Instead, what we have is just further sideways consolidation. I would not be reading into the IWM as a head and shoulder pattern. Just my personal preference. Read it as you will, but these do come at the end of trends, and there was no trend in place when this began forming. So I do agree it's very symmetrical. Again, I don't like the upsloping neckline, but this one's come down with much more force, and therefore I do think it would be more legitimate if it actually followed an uptrend. All right, chart of the day. I want to just take you over to earningsbeats.com. If you haven't already signed up, please sign up. It's free. We do this. I do this 3 times a week, Monday, Wednesday, and Friday, basically to share things that I've learned over the years. It's not always a trading setup. And even if it is a trading setup, it may be one you don't like, which is fine. But at least it'll show some of the things that we like to discuss, things that we believe in at earningsbeats.com. Just maybe round out some of, round out your own technical analysis, maybe add 1 or 2 things that maybe will strengthen your own technical analysis skills. And if you're fairly new to technical analysis and you're just starting to learn it and you're intrigued by it, I think this newsletter will point out a lot of things that you should be at least thinking about. So again, very educational. And those who sign up for this, again, it's totally free, but those who sign up, any free events that we do, we reach out to this group. I probably don't say it often enough, but we do a lot of free events. And if you're a Earnings Beats Digest subscriber, there's no credit card required. So you don't have to pay anything. You won't ever have to pay anything, but it does get you in so that when we do have a free event and we reach out to our Earnings Beats Digest community with a link to the room, you'll get it. Otherwise, you won't. So make sure you're part of this community. It is a very large group and continues to grow every day. All right. So what's today's chart of the day? Well, I pulled up GEHC. If you noticed, I think it was one of the top S&P 500 performers yesterday. You can see pretty big move, but it's been in this downtrend. Well, it's been in a downtrend and it keeps failing at the 20-day. But notice on each of these last 2 lows, from here to here, PPO is higher. From here to here, PPO is higher. That's a pretty good signal. Yesterday's move to the upside. If we get through the 20-day, this is one that I believe goes all the way back up to the 50-day. Now from there, once you get a 50-day test, you get the PPO at or near the center line. I call that a reset. And honestly, where it goes from there is anybody's guess. Sometimes these divergences mark significant bottoms that last for years. Other times it's just temporary. It's just telling us that the downward momentum has slowed and therefore buyers kind of gain control for a period of time. We move back up again, and then we kind of see what the stock is really made of. Looking at it relative to its medical equipment peers, obviously it's showing some relative strength now that it's moving up. The group itself, relative to the S&P 500, has been horrible, really been horrible since about May, which is kind of unusual because if you're going to go away in May, you would think that money would rotate into some of the areas that are just a little bit more defensive. And most areas in healthcare are considered more defensive, though I will say medical equipment is one of the more aggressive, not as aggressive as biotech, but medical equipment is probably next in line. Anyhow, medical equipment, you can see not performing well at all versus the S&P 500, yet the stock showing a little bit of relative strength. And with that positive divergence, maybe we do see this one continue. So that's, and that just is, if you're looking at a stock that maybe is bouncing, you think, okay, 20-day moving average is a great time to short. Generally in a downtrend, it is. With this positive divergence in play, I would not short it. Would I go long? Probably not, especially after it's already made a move yesterday of over 3%. You got a stock that's downtrending. You got maybe another 3% to the upside, maybe 4%, and you've probably got 3 or 4% to the downside. So the reward risk doesn't really make sense. All right, let's talk about this bull bear argument. I got a minute. I'm going to go probably spend a little bit more time than that. The first thing I would just say is, from a bullish perspective, is we have not lost major support. What I consider to be major support, 43.05, right there. We're sitting on it. The bearish historical period is ending today, 7/17 to 9/26. Kind of interesting that it's ending on the same day that we're testing major support. I don't know if that means we're going to hold or not. I'm just saying watch this support level. It's rather important. The next thing that I would point out is the equity only put call ratio. you know, every day, I guess, is a little bit different. Every period is a little bit different. But what I will say is that if we use the invisible chart here, so this to get rid of all those daily readings, and then we do a 5-day, and we can even do a simple 10-day, just put it all on the same chart. Get rid of the volume. Don't need the PPO. We will put the S&P 500 on here. All right. So what I would suggest that well, let's go back a little ways. Let's go back 5 years. And all I'm going to say is that when you get the 5-day and 10-day moving average, 5 days, the blue line, it moves a little faster than the 10-day. 10 days a little slower to react. But when you get both the 5-day and the 10-day up around 0.80, if you look back in history, here was one right here. Look, it coincided with that bottom perfectly. Here, really have to ignore these readings. I've talked about this many times. I don't want to spend a whole lot of time on it. But hedge funds were buying puts on some of the bigger large cap names like Apple, Nvidia, Microsoft, so forth. And they were doing it to hedge. And to me, that's not a true statement of what retailers are doing. So there were about 8 or 10 days back in October and November of 2022 where the put call ratio went through the roof, even during days when the market was going up, which never happens. So it was just an anomaly. I think we really need to just ignore that period. I don't think it was really giving us great signals. But if we ignore that period and just look back into history, now this one got up to 1%, remember, or 1.00, both the 5-day and the 10-day. That was about the highest that we have ever seen, along with maybe the financial crisis, 2008, the dot-com bubble, maybe in 2002, 2003. And then back in here, you can see 2018 during the trade war and that cyclical bear market. Here you can see 0.80. Every one of these, if you go back and you look at where they come up, this came up at this low. This came at this low. This crazy reading, bearish sentiment reading, came at this low. I mean, you can do almost every one of these. This low right here, well, that didn't even get up very high. Right here, June marks this low almost perfectly. Here marks this low. I mean, and here we are again. This is where we are right now. I'm just saying, from a bullish perspective, I mean, this is almost 100% signal. Now, the one thing we don't know is, does the top occur at 8.85? Because if you know, some of these others, when we got up to 0.80, we kept going down. So if we break 4,300, I think we're probably going to go down until we get a capitulatory move. And at that point, I think we'll have a very significant bottom. If I annotate this, though, I mean, also when I talk about price support at 4,300, I want you to just connect. I'm going to just connect these two lows. Somewhere in, I don't know, right about there. Notice that comes in between 4,200, 4,300. So we got our major trend line coming up, getting pretty close to 43. Maybe intraday, maybe even for a day or two, maybe we break below the 4,300, hit the trend line and bounce. I don't know. But I do think once we get below 4,300, or if we get below 4,300, you want to be much more cautious. For me, if we move, I'm going to probably give it a little bit of room, but if we move much below 4,300, maybe 4,290, 4,295, I will be in cash. And I will just wait for the capitulation. If it means I have to get back in at 43.10 or 43.25 or whatever it is, I'm fine with that. I don't want to see whatever happens below 4,300. So just keep that in mind. The market's now open. Let me give you a couple of things I don't like real quick about the market. and why perhaps you could argue. Let me go all the way back over here. Look at the AD lines. Hey, if I'm going to talk about the AD lines remaining strong when the market's going down, I got to tell you when they're going down. And here it has been a pretty big drop throughout this move. Now, it's only been going down after the top. There was no real AD switch back before the top. But at the top, as we've rolled over, we've seen the AD line dropping. Here, S&P almost maybe just slightly started to see a drop right before the top. Probably most of it because of that big red filled candle at the end of July. Nasdaq at the top, right there, AD line was strong as we've been moving down. Even though we haven't broken down, the AD line looks like it might be slightly lower. Mid caps falling apart, small caps falling apart, transports. So the AD lines absolutely at this point in time favor the bearish side. Let's talk about a couple of key areas real quick. Weekly charts. And I'm going to go back 15 years because I want to show you how stretched the PPO was on semiconductors. And I wrote this 4 weeks ago, I think it was 3 weeks ago, beginning of September. I wrote about this in our first weekly market report. I was nervous about the semiconductors because the weekly PPO got up to 10, which you can see it never did in the prior 15 years. That was the most momentum we've seen to the upside. And if you look back when we've been at 7 or 8, you'll see that the potential upside down the road seems to be somewhat limited. I mean, here we get to 6, 7 down. Here we get to what, 7, and we go down for, I don't know, probably half a quarter, work our way up for another couple quarters, but then we're down literally almost a year later. We're at the same price we were when we were at that PPO of 7. So I'm kind of thinking, look here, we got up to 7. We went down, we went up a little bit more, looks kind of similar with what we saw here. Negative divergences emerged. A year later, we were lower than we were at the top. So I'm still thinking, even if we move higher, even if the market rebounds and this group goes up, I just don't think this is your leadership for the next year. And so semiconductors, and I'm going to throw software right in there with them. I mean, look at the PPO here, pretty close to as high as we've seen. What happened here when it was up that high? Went down, went up one final high, went down again. And it was a good solid year before we made a meaningful breakout again. Here, well, here's probably 5 months, maybe sideways consolidation, but we did continue to move up. And I would also argue maybe the pandemic might have had something to do with that. We've seen a lot of strange things coming out of the pandemic. Bottom line is, anytime you see something with a really stretched PPO, I think you have to be cautious. The chances of it continuing at that rate to the upside, very slim. So these two groups, big part of technology, 27% of the S&P 500. If these two groups are going sideways or maybe slightly higher or even lower, it's going to be hard for the market to really move up a lot. And then finally, that head and shoulder top, which I talked about. So we got a lot of things on both sides. Pick your side. I know I can tell you where the media stands because the headlines are outrageous right now. And even they're talking about crude oil is gonna trigger a big sell-off. I've shown charts to our members. Rising crude is almost always in a market, occurring when a market is going higher. So I'm not sure I'm buying into that argument. Anyway, that's it for me. Let's see what the market is doing. I know it looked like we were going to be down. Yeah, we're having a pretty rough start. Dow down 0.4, S&P 0.6, Nasdaq down 0.6. Small cap, I don't know. The IWM wasn't looking good. Let's see what the IWM is doing. All right, so it's rebounded off that earlier low. I don't know. We'll see what happens. Yesterday we opened at the low and we came back up. Do we do it again today? This would be an interesting level. Let's see if the S&P got back down. The low today, 43.05. Still sitting down here, 43.11. This is the area. I mean, this is a key area. I don't talk about price support levels too often being like the level. But I think in this correction, I think 4,300 is a big deal. Anyway, I'm going to stop there. Sorry, I ran over a bit. I think it's worth talking about though this morning. We'll see end of the seasonal bearish period. Does that have an impact? Just about over. September earnings season coming up, but you saw those AD lines. You saw the head and shoulder tops. Just keeping it real here. We got a lot to think about. 4,300 level, though, is pretty big. Have a great day, everybody. Happy trading.